I wanted to speak a bit about some of the tensions that exist in the U.S. China economic relationship. It's a tremendously important economic relationship, and there are obviously extensive and growing business ties, which are exceedingly important, but those ties, with some frequency, are threatened by tensions, by diplomatic tensions. So I wanted to say a bit about the source of those tensions, about how we sort of understand them, give some background, and maybe what prospects there are. So I'll divide my remarks into just a quick word about Chinese imbalances to sort of continue the conversation that Dean Tsai began, talk about where some of the U.S. critiques came from, and then talk about some of the economic challenges for China moving forward. This is by no means to deny that there are economic challenges for the U.S., but I'll leave those for questions and answers. So, is there tension? Yes. I've just tossed up a couple of quick examples there. We see political discussions pushing against China's currency manipulation, the Treasury slamming China on currency. Note, I'm reporting these critiques, not necessarily endorsing them. And part of my purpose here will be to say, where is this coming from? What is the basis for this? All right. Well, one basis, this is what sort of lurks behind some of these concerns, is Dean Tsai's points about the sort of mismeasurement of consumption and investment were very well taken. And it's very important not to apply sort of one country's accounting standards blindly to another's, and he gave an excellent demonstration of how that could be misleading. However, we can also see in international statistics a different perspective on imbalances. And so what I've put up here, this is the first of a couple, this is looking at China's current account surplus as a percentage of Chinese GDP. One of the things we've noticed that sort of tensions have waxed and waned over the years, so has the current account surplus, not coincidentally. So we see that there was a period there where this reached a really quite dramatic 10% of GDP. It's been much more moderate in recent years, post-crisis. Nonetheless, it does remain a point of concern. And one reason, and one thing that I think gets to be a focal point, certainly for American politicians when discussing this, is one result of these persistent imbalances, sometimes larger, sometimes smaller, is China has accumulated a very dramatic stockpile of foreign exchange reserves. It was part of how the sort of what would otherwise have been a very sharp appreciation in the currency was moderated. But you see that, again, this is not something of constant slope. There are sort of periods where this sort of rises sharply, periods where it rises more slowly, but it has accumulated to on the order of $4 trillion. I think this offers a tempting target for U.S. politicians when they look at this. Sometimes the interpretation of this particular graph is that this is like a giant stack of poker chips, that this represents winnings. And for those who don't have such a big stack of poker chips, it can encourage resentment, and it can encourage questions about what did you do to get all those winnings anyways, and was this always fair? And I think that's some of where these critiques come from. I think, in fact, we can question seriously whether this is a good thing for China or not, that it is a reflection of imbalance, and that it's one that poses its own risks for China as we move forward. But I'll come back to that. I said there are a number of critiques, and I'll move through this fairly rapidly in the interest of time. You get both less and more sophisticated critiques of the U.S. China economic relationship. I'll start with some of the less sophisticated. I was recently testifying for the U.S. China Economic and Security Review Commission. This was a couple months back in Washington, and it was on the question of whether China had basically destroyed U.S. jobs. The argument for the prosecution effectively came from Dr. Robert Scott. This is going to be a little bit challenging to read, but he basically gives a portrayal and says we can look at trade imbalances and from that compute fairly directly how many jobs were lost. He notes that what he's seeing, and he traces the trade imbalances in turn to currency manipulation. He notes that currency, he says, I'm looking at 20 countries, but China is by far the largest currency manipulator. And in some of this work, which has achieved a fair degree of prominence in Washington, it's a fairly direct calculation that you have currency manipulation, that makes for bilateral trade deficits, that translates into jobs lost. There are all kinds of problems with analysis like that. First, the direct translation from currency into bilateral balances. But second, it is a multilateral trading scene. If you look historically at, for example, the U.S. share of imports from Asia, the U.S. share of imports from Asia as a whole has stayed relatively constant over about the last 15 years. What that suggests is there's been a realignment of trade within Asia, that China has certainly emerged as a much more significant trading partner, but that often reflects things such as trade in intermediate goods, something where China's adding a certain degree of value added, but because of the way that, continuing our theme of caution in interpreting statistics, the way that bilateral trade statistics are put forward, if you have a good that's 90% finished in Malaysia, and then 10% completion value added in China, it will count as a Chinese good. So there's this fairly facile critique, which has gotten a fair bit of attention, but I think can be set aside fairly easily. And just to note, one of the ways we can set this aside, we might as well take a quick look at currency, since it's right at the core of some of these tensions. This is just to recount a little bit. This is showing renminbi to the dollar, and I apologize, I'll be flipping everything upside down in a second. Part of what happened is if you look at that initial period, China had been following a fixed exchange rate regime for quite a while. At one point, that was thought to be best practice in the developing world, but it coincided, if we flipped back, and I won't, but if we flipped back to the period of China's current account surpluses, this fixed exchange rate persisted while those were beginning to accumulate on a multilateral basis. That caught the attention, and it sort of gave an impression of China as being a country that was sort of reluctant to make necessary adjustments. You did see adjustments that ensued, and we see long periods. They're the only real interruption. Well, two notable periods. There's the period right after the global financial crisis, when China essentially froze its nominal position, and I'm noting here this is just nominal renminbi to the dollar. And then we've actually seen this very curious recent thing where you've had a 3.4% depreciation of the renminbi. Too soon to pass judgment on that one. But otherwise, a steady trend of nominal appreciation. And now I've flipped everything on its head, so if you want to turn around, you can look at it that way, or you can just be imaginative. Actually, from an economic standpoint, the more significant thing to look at is real appreciation of the currency, where not only do we look at the nominal, but we also add in relative price movements, where you've seen faster inflation in China than you've seen in the United States. And there you see a much steadier, again, you were seeing some movement during the global financial crisis, but a much steadier sort of appreciation, even during periods where the nominal exchange rate was relatively fixed. Okay, so there was that first set of critiques, which was fairly facile and said, okay, anything that's not being made in the U.S. being made in China, we block trade and we can reverse that. There's a more sophisticated set of critiques that have also played into this, and it's worth distinguishing between these two. And I think sometimes in discussions, that first class of critiques ends up overshadowing the other, but it's worth paying some attention. And here Paul Krugman reemerges in a somewhat different role, still critical, but in a different way. And you can think of this as the sort of global savings glut argument, and it is tracing back to imbalances. So there were early sort of foreshadowings of this when Ben Bernanke, then at that point a member of the Fed Board of Governors, gave a speech talking about a global savings glut. He didn't specifically mention China, but China was clearly implicated in his talk, saying that this excess of savings in a global scene, it was the counterpart of those current account imbalances that I showed. The excess of savings resulted in very low interest rates around the world and was contributing to sort of dangerous behaviors, what we would later think of as the U.S. housing bubble. That was sort of an anticipatory critique. In the wake of the global financial crisis, there was another set of critiques, and this was a very Keynesian set of critiques. This was saying that we can look and see, the Keynesian diagnosis of the crisis, not one that I entirely share, but was that you've got an awful lot of supply out in the world and you've got very little aggregate demand, and that by running current account surpluses and pushing savings out into the world, China was exacerbating the situation. So more sophisticated analysts like Paul Krugman and Fred Bergsten said it was in this way that China was costing U.S. jobs. That it was the opposite of what was being attempted through the recovery, that we had an excess of liquidity anyways, adding to that liquidity was stymieing recovery. And these critiques led to a sense of policy blockage, that there were attempts at the multilateral level, for example, a G20 meeting in Seoul in 2010, to try and say, clearly we live in an international economy where one country's balances affect another. Can we establish some norms for what's appropriate behavior? And that actually failed. China opposed it. The norms were something like setting a 4% of GDP threshold, not for some draconian response, but even to sort of acknowledge that there was a problem. Note, by the way, that China would not exceed that threshold right now and would not have for several years. But China opposed this, as did Germany. So China was hardly alone in doing this. But the U.S. has also, there's been frustration pushing on currency manipulation at the IMF or through trade talks, again, encountering opposition, and in some cases, quite reasonable opposition, because many of these ideas are very poorly thought out. Now, I would just note that there's a couple of different perspectives one can take on this, and it's an odd facet of these tensions. On the one hand, you can say you're getting these critiques from the United States. On the other hand, there are real questions about what's even in China's best interest. I think that you can certainly make a case that these particular imbalances that I've identified are not in China's interests. There's the global effects and the potential backlash that we've discussed, but you also have what is now a middle-income country lending large amounts of money to rich countries, which, if we think about consumption smoothing, is not usually the way you want to go. And in fact, the problem is exacerbated because some of those rich countries look like rather dubious credit risks. So you can ask about what the real return will be on China's investment. If you think of that $4 trillion as an investment, you've got risk in at least two dimensions. When the renminbi appreciates, you lose. And if interest rates go up, you lose. And even a small loss percentage loss on $4 trillion can be a fairly significant loss. And as I put up a little graphic, this is a view that is recognized in some parts within China, the PBOC saying it's no longer in China's interest to increase reserves. Getting out of that situation is not an easy thing. What does this all have to do with rebalancing, the topic of this session, or a topic of this session? Of course, for an open economy, the gap between savings and investment is the counterpart of the gap between exports and imports. So to the extent that one can accomplish a shift from saving to consumption, the expectation would be that other things equal, that would shrink or eliminate trade surpluses. It is worth noting, of course, that the exchange rate, which has been the focus of much attention with charges of currency manipulation, is only one factor affecting these balances. Others include the rate of return on saving, demographics, the presence of social safety nets, and even the distribution of income between, for example, the business sector and the private sector and the household sector within China. So, all right. So where are these critiques coming from? I've given you sort of the content of the critiques. Well, altruism, maybe a little. It's not a principal force, but you do have analysts who sort of look at this, and myself included, and think what imbalances we see are not good for China. There's another factor, which I know that sort of Chinese respondents have often focused on. There's a certain degree of despondency about manufacturing. That's what's driving some of this. The manufacturing sector has been doubly hit. When you have a downturn of the sort that we've had, you necessarily see decreases, well, not necessarily, it is to be expected that you will see decreases in output and in turn decreases in employment, and we have. So that exacerbates the pain. But what we've also seen is a much longer term trend in manufacturing that has coincided, at least the latter part, with China's emergence, but it's a longer term trend away towards more capital intensive techniques and away from such labor intensive techniques, especially the demand for less skilled labor has diminished greatly. That has been seen as a real challenge, and now there's a lot of, it's beyond the sort of scope of our time here, but you can point to technology as a culprit, but many people actually point to foreign trade as a culprit, and China is first and foremost among the concerns. Lastly, I would note in terms of the motivation, there is some concern about global rebalancing, that there's a sense that it is a global system, and that if you think about, for example, recovery, which has been tepid from the recent global financial crisis, where is the effort and the drive for that recovery going to come from? And it matters, because it's hard to imagine Europe leading this. The U.S., which in the past might have launched a consumption boom to sort of increase global demand, is not really well positioned to do this, given existing debt levels. And hence, when you look at sort of the net demand coming out of Asia, it is a part of broader concern. And the thought would be that if you went from current account surpluses to actual current account deficits, that would contribute to a global rebalancing. Finally, I'll note, some of this is motivated by a general concern over global rules and fairness. And there's a number of points, and Dr. Hormat's mentioned some of these, where there are just differences of approach, and how does one deal with trade issues? I would have given a slightly different answer on the TPP question, but I can, if someone asks it again, you'll hear. Subsidies, state-owned enterprises, and what relationship there is between currency and trade. I would note that many, again, echoing some of what Dr. Hormat said, many of the signs that we've seen have been very encouraging. I think if you look at the commitments of the third-party plenum, they were quite impressive, and difficult to implement. So therefore, you're getting a bit of a wait-and-see attitude on the part of the United States. But some of the reforms that I think look necessary, things like increasing dividends from state-owned enterprises, more market determination of prices, and, as we had in our first presentation, financial sector liberalization, those seem to be very politically challenging, and it'll be interesting to see how they play out. But they do certainly offer some signs of encouragement. So just to close with some points of agreement between myself and Dean Tsai, I do believe that the quality of investment in China matters a great deal, and that looking towards that as opposed to simply a blind rebalancing is a wise idea. And I'd say there's ample opportunity for both Guanghua and Kellogg graduates to play a leadership role. All right, thank you very much.